Do you think this carnival is just getting started, or does it run the risk of having already reached the dawn?
Well, I think from a length perspective, we have a long ways to go. You've gotten a lot of the return already in the past couple of months. There's no question about it. We think there's more to come. We think rates are going to continue to decline as the Fed normalizes policy. Whether or not we go into a recession, a soft landing, those are all questions. But I think undoubtedly short-term rates are going to be lower a year or two from now, and most likely long-term rates will be as well. So there's more to go, but you got a lot in a very short period of time.
Mm-hmm. We saw a little uptick in the 2-year coming off of those weekly jobless claims numbers, holding at a level that we've seen as of late, coming in a little bit higher than forecast. Having said that, I do have a question for you, Gershon. I mean, when you talk about rates, where do you see that 2-year going if you think that there's more room to the downside?
Well, look, the 2-year in the not so short, like in the intermediate term, is going to follow Fed policy. So we're going to have to see. I think that the market is really.
Well, wait. Can you commit though in terms of where you think it might go?
Can I commit? No. I mean, it depends. If the Fed cuts, 6 times next year, like markets are implying, maybe we'll get back to what that means. And maybe more, then yeah, it's going to go lower. If they're slower, then it won't in the short term. But the long term, the long term part of the curve can continue to rally if the market anticipates that yields are going to be coming down. You saw it on the way up, right? The long end of the market sold off long before the Fed started to move, and you're seeing the exact opposite now, and that's how markets work.
Well, let's get to the psychology of that bid for duration, whether this is basically people saying, okay, there's a growth hiccup coming, there's some growth concerns being priced into the long end, or whether this is duration FOMO, that I missed out when rates were super high at the long end, now I want to catch them before they go too low. Where do you fall on that argument, and how does that translate into the world of high yield credit?
Well, I think it depends on what regime that we're in, right? If you look at yields today, the long end relative to what they've been the past 15 years, they still look very attractive. If you look at it versus the past 50 years, not so much. When I started in the industry in 1998, the 10-year was about 5.5%, which was towards the low of what it had been over the previous 20 or 30 years. And everyone thought, wow, rates could only go up. And now you're seeing the exact opposite. So it really depends on what regime we're in. I think high yield credit is in kind of that sweet spot right now between the kind of extremes. So if things are okay, and if inflation's coming down, the economy's not going to roll over, the Fed's going to cut slowly, normalize rates, then equities are going to continue to do very, very well. But if we're going to go into a much more of what's called a recession or a hard landing, whatever you want to call it, equities are mispriced and long-term rates are going to rally a lot. But there's that in-between space, which might actually be the highest probability of like a soft landing type of scenario. And that's where credit, and high yield in particular, sits in that sweet spot. It's going to clip your coupon. You're not going to have a lot of defaults, and your returns may even be better than in the equity markets.